All right, stocks didn't start out the week on a very good foot. We kind of rolled over and hit some new lows for some indexes. So I'm going to break down what this selling today looks like in context of what we have been seeing to see, how likely we are to continue this leg lower to the downside. There were some interesting kind of very oversold signals that we saw today, particularly on the NASDAQ. So we'll talk about that and what that means and how likely we are maybe to get a bounce. And then the question becomes, is it just a small short-term bounce? Is it more of a longer-term bounce? We'll take a look at past precedents, see some examples, and see what we can expect to see going forward from here. We'll talk about what's driving the price action. Really, really big moves, especially in bonds today. So we'll break that down, how that impacts expectations. Big meeting, FOMC meeting coming up this week. So on our trade ideas, a stock that is also kind of rolling, had been on a really good little run, but it looks like it may be making a leg lower with a little bit of a bearish price pattern, continuation price pattern developing. So we'll talk about how to trade that. So let's go ahead and get started. Today is Monday, March the 14th, 2022. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. And you can see another down day today, getting back the second day now. We've closed below this long-term 23% retracement level of the post-COVID rally that we've been on. You can see we closed below these lows. We're coming down from another bearish near-term peak, a peak that got into bullish territory but did not get in the reversal zone or to really good high levels, and is already back down to pretty deep bearish levels here in the lower reversal zone. Market sentiment's dropping, the intermediate line's dropping, dark pink shading and a red line. We're well below the moving. In fact, the 30-day moving average now is down below the 38% retracement, which is going to strengthen that resistance even more on any kind of rally back up to the upside. Let's take a look at the NASDAQ. We got a cluster today, an oversold cluster. This time almost with the market sentiment line as well, which is crazy that we are to that point. But you can also see too that we are breaking down. We're close to that 38% retracement, which is a pretty decent support level for the stock. We actually closed below just slightly, but we closed below the low on the 24th, which ended up pretty much being the open on the 24th before it rallied back up. Got the cluster the day before that. And then you look at the Russell 2000. And the Russell 2000 is also relatively bearish close. We're back to dark pink shading and a red line again. We are back below that 23%. We're down below that 23% in the last couple of days. Intermediate lines falling. It's still in neutral territory, so it's not back in bearish territory yet. You can see the near-term line didn't stay in bullish territory for very long. We're getting very short spurts to the upside on the blue line instead of the nice, good, extended runs that you get when you're in a bullish run. So we're coming down, and they don't tend to be very long on the downside either. So that's why it's a little bit different. Bearish intermediate runs are different than bullish. There tends to be a lot of upswings because, again, the further you get below the moving average, especially the short-term moving averages, the more likely we are to bounce right back up to them. If you take a look at this chart, you can see the 10-week moving average has now crossed below the 40-week. You'll see we also got the death cross on the daily averages too. Falling PPO, that's what that measures. Negative differential on the Hakinyashii candle. It's been negative for a while here. When you take a look at the Dow Jones, you can see again, same thing in the NASDAQ here. Let's go to the NASDAQ. The NASDAQ has been in one for a while, and you can see it's down to that 38% retracement level. Very strong. I mean, we haven't, again, you have to go back to some of the last corrective moves that we've been this far below. In fact, COVID didn't really get, this is about as far as it got to on the COVID drop. And then, of course, this is not here, let me make sure we got the log scale in here. So we got about this low on the COVID drop. Or excuse me, we did not get this low on the COVID drop. We got about this low on the 2018 drop. And then, of course, the 2016 and then 2011. So this is, we're on par right now with another, pretty deep gap between those the long-term moving averages there. Let's just go back to this one and take a look at the Russell 2000, and you can see it's also pretty, 4.76%. Not as bad as it was during COVID. That was a little different. The NASDAQ held up really well during COVID. But it is kind of starting to get on par with some of these other corrective moves. I guess we can go down a little bit further down towards 7%. 8% is where we got to in all of these, and we're at 4.75 right now. When you take a look at the 3 green arrow charts, we can see light pink shading across the board. We have 3 red arrows everywhere. Everywhere's got 3 red arrows, except for the diamonds, which still has the 2 green arrows in the stochastics and the MACD. In fact, the MACD histogram is actually rising there. When you look at the 2-line versions of this, again, that's like I was saying, when you get so far below this 8 and especially the 17, we tend to ramp back up towards it pretty quick. Not a whole lot of volume today. And there's that long-term 23% retracement. That's a very important support for this. If we were to, break down below that a little bit more significantly, you can see the Russell, the MACD is relatively small, so there's a small gap there. We can really extend away, even though it's already pretty darn low below the 8-day moving average, just like that. And you can see how the gap between the 50 and the 200 is really rising. If you look at it on this, the 50 days is just barely crossing below the 200, just barely starting to get there. So again, we're kind of just starting, and I mentioned to you before the weekly versions of this. There's the weekly chart, and we are finally below, well established below that 50 week, and starting to fill in the gap between the 50 and the 200 week. And I mentioned to you before, IWM is well more than half, is about halfway to doing that. So that kind of gives you an idea of just how bearish the small cap index has been relative to the others. Obviously, you still have a bearish pattern here. That ADX is really rising up to high levels. Same thing with the Qs. The Qs, finally, the positive indicator has dropped below 10. That tends to be a pretty decent sign for in terms of extreme lows, especially with the ADX above 40. We just haven't had that for a very, very long time on the NASDAQ because it's held up so much better. I mean, again, this COVID drop was about as low as bearish as NASDAQ got. This is the last time we had above 40 and the blue arrows down here like we have right now. And you see that there. You also see it too in fourth quarter 2018 when we kind of first started there. The ADX didn't quite get up above 40. But it's a, again, pretty parabolic move right now on the Qs. And then IWM. Again, that doesn't necessarily mean the trend is over with. It could mean though that we have a pretty decent short-term low point in terms of how extreme the selling has been here over the last little bit. When you look at like the RSI and the CCI, of course, we're not too bearish there, so that kind of gives you an idea that we're not too extreme. The Russell's not even in bearish territory on the RSI, and then the S&P is also just barely down below there too. So we had our extremes there back in January. We got down below 30, but we're not so extreme again right now. The trend strength indicators, you are almost to a mature bearish trend on the S&P. The Qs have been in one this entire time, and it's getting pretty extreme at that point too. IWM is just starting a new week. It's very weak. It's about as weak as you could possibly be, because you have to be below -1, and we are just barely. You have to be above 50, which we are just barely. So we have a very, very weak bearish trend going on IWM. So that kind of gives you an idea that IWM maybe has a little bit more room to go versus some of these other indexes right now. And then finally, our Bollinger Bands, we are still in the lowest quartile in the S&P. The IWM is also back into the lowest quartile, and the QQQs continue to trade in the lowest quartile and below the point of control, or the value area for the 1 year. The S&P is not quite below its value area. That's where that really good support level is. And IWM has been below its value area for a long time. So it's pretty significant to get below the value area. And that's if the Qs break this 38% retracement, as bearish as it is, I mean, that's a really good support. So you'd expect the support to hold until it doesn't. But if it doesn't, then you can, again, 258 is not out of the realm of possibility whatsoever. For a new support level. I mean, to kind of give you an idea of what that looks like with the 200 week moving average on the Qs, you're looking at right about to that 200 week. That would be the rest of this correction. So keep that in mind. And those kind of moves can happen really quickly. As we've seen previously, you can fill in these gaps between the 50 and the 200 really, really quickly. This has actually been one of the slower moving corrections that we've had in a while, because we've been below the 50 now for 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks. So I think again, I kind of expect in the very short term that this support will hold. We might get a bounce back up to one of these. But if we don't, then expect that we'll get down to 258 probably within a week or two. Like a good kind of washout, sell-off, where the volatility really ramps up. Because remember, we still haven't had volatility ramp up. Volatility is not even above 100% relative to the VIX 3M. So the market is still concerned about that kind of move. Right? You would think that, in this kind of normal selling, as bearish as we've been, the VIX would be way up here above 105%. Because it's been above 30 for however many days in a row. But that's not the case. I mean, we are above 30. I mean, the last time we were at this 95%, we were here in the high 20s. I mean, you can go back here. You can go back to some of these other levels. I mean, over here you were at 95%, and we were trading in the low 20s. So, I mean, to be at 95% in the low 30s means the market's still very concerned about, a bigger move, right? A bigger, longer move. And you see that as well in the skew index, and where it is. It's not, it looks like it has been updated. It's still in the 130s. So it still hasn't dropped down to those levels where it's kind of where the market feels like it's got the move it's been pricing for, right? I mean, it got below 120 on a normal intermediate move. We haven't gotten below 120 yet. It got way down here. The average got below 120 during COVID, and the average was well below 120 during 2018, and these intermediate pullbacks here got down to 117.5. The average is at 130, so the market's still concerned. The market is still very concerned about a bigger move than what we are, at least a continuation of a decent sized move than what we have right now. Let's take a quick look at today's range. You can see we did end up with a lower high and a lower low. We closed below yesterday's low. We did not close below last week's low point. So keep that in mind. Again, expect support to hold until it doesn't. That's on SPY. The Qs did get below last week's low, and so did IWM. So again, relative bearishness there. We'll see if that ends up being a fake out. Like if tomorrow we bounce right off this cluster and these end up being fake outs, great. Get back above last week's low, great. Right? But if we end up holding and extending, then again, look for that 1 to 2 week. I think that's a lower probability scenario of happening. That 1 to 2 week washout where we hit the 200 week moving average relatively quickly. I think that's obviously a lower scenario. The market is concerned about it. That's why the skew is up. That's why the VIX is so low at 95%, the VIX 3M. Because, if we do wash that out, it's not going to bounce back up in a week or two. Right? It's probably going to bounce around those areas for a while. That's why VIX 3M is so high relative to the VIX. Right, so I think that kind of washout move is a lower probability. I think the higher probability is that we'll get there, but more gradually, right? We'll probably bounce off of these extreme lows we're at right now, and then more slowly get down to those levels that we talked about after we get through this FOMC meeting this week. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggest why you're either a lot more bullish than I am or a lot more bearish than I am? All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. One, you liked our video today. And two, you want us to do another video again tomorrow. A quick way to give us feedback and let us know you like our stuff. Of course, if you don't like it, you don't have to watch. You don't have to click on anything. Also, while you're down there, comment. What stood out to you from today's video? What questions or comments do you have about anything I brought up? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right. Click on this icon, Market Outlook Live. It takes you to this page. You can see our Market Outlook Live videos here at 3:30 Eastern Time on this page. It's just a quick 15-minute video. I take a look at all the trades we put on in prior market outlooks to see whether or not we should stay in them or get out of them. And we talk about how to manage and when to exit and all of that, which is probably the most important part of those trade ideas instead of just getting into them. You can also get to it up here if you click on Market Outlook Live Trade Review. If you come down here, click, as you can see our upcoming classes, click on View More, you can see the full calendar as well as all the recordings going back 4 years now. You can also get to this by clicking on Trading Rooms up in the menu. Come down to the bottom, hit that heart. It opens up this tab, hit that like button. Also click on this thumbs up icon, opens up another new tab. Hit that like button as well. Again, the more you do that, it helps us get our content out to all of our followers instead of just a very small handful based off how these algorithms work. That's why we always ask for the likes and the comments and the shares. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with. So we try to make it really easy for you to engage with us right here. All right, now let's talk about what's driving this price action today. Let's take a look at some of the moves these different asset classes had just today alone. So here, let's zoom out to March the 14th as we head into March Madness, the time of year. Commodities really dropping hard. They were so bullish, right? They were so bullish, but they're really dropping hard as economic growth expectations drop. Bonds dropped hard too. So bond yields, which we've been really paying close attention to kind of gauge what the Fed, I mean, look at that, 11 basis point jump in the 2-year note. This is the indication of what the Fed will do. So if you take a look, of course, the Fed's not going to raise 50 basis points this week. That's not widely expected. You can see there's about a 1.7% chance. But this December is what really is people paying a close attention to. So you can see we have 100% odds to 4 rate hikes for this end of the year. And you can see, 100 minus 0.8, 99.2 for the 5th rate hike. It is 93.3 for 6 rate hikes. It is now a 73% odds, so we're high probability we'll get a 7th rate hike. So 1 at every meeting for the rest of the year. And then, of course, now you're at the high end of low probability for 8 by the end of the year. So it's still low probability, but you're at the high end, 40% and lower is low probability. So we're almost a coin flip odds for an 8th by the end of the year. That's how significant this is. When you look at the spread, it wasn't just the 2-year that jumped, it was the 10-year too. The spread's still at 28 basis points. So the spread's holding up well without getting down below. When you look at the spread here, the 10-year note, it took off today. It rallied up to kind of a parabolic type move here, 2.14%. So getting above 2%, right? That's a significant change. And look at that big move. Not a whole lot of volume there, but a big drop to the downside on TLT, well below its moving averages, way below its moving averages. And you can see it's also getting a pretty significant cluster with the market sentiment line down there too. You can see we're nearly 5% below. That's about as low as we get to the 30-day moving average there. Here's what the weekly chart looks like for long-term bonds. And you can see we're also, again, we're only 1 day into the week, so keep that in mind. But we're also in the midst of getting a weekly cluster on this. So very, very low move, very oversold. You can see the intermediate lines, let's go to the daily. The intermediate line is in the 15th percentile. Getting below the 10th percentile tends to be a pretty darn low, extreme low for that. That is bonds. You can see gold continues to pull back from that kind of spike that we had, that cluster that ended up having, and that run up to the upside. If you look at the dollar index, the dollar, or this relative to the euro at least, it had also gone parabolic to the euros to the downside, for the dollar to the upside. It could not get down below these lows. Could not get down below this low point over here, so it's gotten to the 100% mark. It couldn't get back above that 78% yet either. That's really important for the dollar. If it gets back above that, that's going to be really bearish for the dollar. If it stays below it, then we're kind of on maybe a more of a bearish longer term run than we think we are. But I think it's the other way around, right? I think we got that cluster last week. I think there's a good chance that we are way below, in this case, the 30-week moving average, and there's a good chance that we run back up. It's uncommon for the currency to be that far below for very long, right? We tend to make a move back up to the moving average, and I actually kind of expect that to happen here. When we look at the major global markets, the 12 grid here for the major global markets, you can see, look at China dropping like a rock. Russia's obviously done right now. Korea's down pretty sharply. This is a good measure of global growth, economic growth expectations. European markets are bouncing up a little bit better than other areas. Japan's still down. Brazil is pulling back, and so is Canada, but those look like good bounce opportunities there. When we take a look at how the sectors have performed, let's take a quick look at the sectors here. You can see, clusters across the board across X, L, K, Y, and C. Right, those are your kind of cyclical areas. Staples had a cluster, but utilities have been holding up pretty well, along with energy. So you can kind of see where the weakness is. There's a little bit more of a bounce, kind of like those European markets in industrials and financials and real estate, but oversold across these. So I think we might have an opportunity again for a short-term bounce to be led higher by these really oversold, the high-tech, mega cap growth names that dominate the capitalization of these market cap weighted sectors here. All right, now let's take a look at our trade idea of the day. Let's take a look at Plug Power. And you can see Plug Power just barely got a cluster. Like the intermediate trend got above 80. It just started above 80, but then it didn't last very long. We've already rolled back down. Very bearish short-term sentiment, which is not typical of what you would see. We don't have the light green shading, but you do have the yellow line. Your intermediate lines drop, but it's still in the upper reversal zone. But that's not the kind of bearish sentiment you'd like to see in a new bullish move, and especially with the market sentiment still in the lower reversal zone. This is what the 3 green arrow chart looks like. We dropped well below the 17-day moving average. So there's a gap, pretty sizable gap between the 17 and the 30, which typically when you have this kind of move and you're just a little bit below 30, you might there might not be that much of a gap there, and you kind of drop below the 17 and the 30, but just barely. But that's a pretty sizable drop from being well above the 8-day to being below the 30 and the 50 here. And you're also, again, you rejected a really strong resistance level at the point of control. You're coming down to an area of very little volume below us, so the path of least resistance to the downside. Your MACD is dropped below its moving average. It's still positive, but it's below its moving average with the stock well below the 17-day. That's a bearish divergence, so that was actually a good. It suggests that there's a bearish move developing. If you look at the DMI, the negative indicator didn't quite get above 25 yet, but the positive has dropped back down below 20. The RSI and the CCI, you can see, have gotten back down into bearish levels, below 50, below 0 on that indicator. If you look at the Ichimoku cloud, we have been in the cloud. It did drop back below that green line. It's flirting with getting below the blue line. You can see we're kind of noisy right now, but we're not quite breaking out anymore to the upside. And then the Bollinger Bands, we were in the upper half. We're not in the lower quartile yet, but we are in the lower half of the bandwidth. So just like that, and again, you can see very little volume below us and a lot of volume above us. And it kind of looks like a flag pattern with this bearish move to the downside, and then we have this bullish flag. And, again, with the bearish divergence suggesting we might get a leg lower, similar to what we had going into the flag. So what we decided to do on that was to do a long put vertical spread. So we bought the at the money put, sold one strike away out of the money to offset some of the cost. We position size fully because we don't have to worry about the earnings. So we're getting about a $1,250 reward for $1,000 of risk at the normal level. Of course, we don't have to take the full 1,000 because you can see if this goes up to 27, we'll lose half that. So 27 would get us back above this point of control. That would easily change this breakout and change the narrative of what we're trading here, our expectations. So we'd probably get out of this with a couple $100 loss. It won't be very long if it changed. To get out of this. So when you look at that 1,250, when in reality out of the 1,000, we're probably risking at most 500-600. That's a pretty decent, that's a 2-to-1 reward to risk ratio with a relatively high probability of getting that. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Remember also you can subscribe to our website at marketscholars.com for free. Like us on Twitter and Facebook, as well as on LinkedIn and other social media too. And like I said, comment on everything. Have a great rest of your Monday night, everybody, and we'll see you all next time.